Welcome to The Explainer. If you're thinking utility stocks are just a snooze fest, well, you really need to see what's going on with Sempra Energy right now. They are sitting right at this fascinating intersection of predictable, boring utility stability and massive, almost unprecedented infrastructure growth. If you follow the energy sector at all, you probably know they operate in two of the absolute biggest economic engines in America, California and Texas. But what's happening under the hood today is literally transforming this historically reliable dividend payer into a high-octane growth engine. Let's get right into it.
Okay, let's dive into this number. $65 billion. It's a staggering amount of capital, right? And it represents Sempra's newly upsized 5-year capital investment plan running from 2026 through 2030. To put that into perspective for us, this isn't just about patching up old power lines or routine maintenance. This is a highly targeted, massive deployment of cash aimed at totally modernizing and expanding their energy infrastructure. And it completely rewrites the expectations for what Sempra's future growth actually looks like.
So here's our roadmap for the Explainer today. First, we'll do a quick Sempra market snapshot. Then we'll unpack that $65 billion plan. After that, we'll look at how they are winning the regulatory game, check out their energizing infrastructure projects, and finally wrap up with the shareholder outlook.
Starting off with Section 1, a quick market snapshot. You likely recognize the Sempra logo, especially if you live out west or down south. Their core mission is pretty straightforward, but huge, to build America's leading utility growth business. They own one of the absolute largest energy networks on the continent, leading really heavily into electrifying and improving energy resilience in California and Texas. Operating in the two biggest economies in the U.S. gives them an incredible geographic advantage. Basically, if you live in those states, there's a very good chance Sempra powers your daily life. But, as you can imagine, that immense scale also brings some really unique operational and regulatory headaches.
Now, what's genuinely interesting here is the baseline. Looking at the recent market data, Sempra sits at a massive $60.3 billion market cap. They pay a very respectable 2.85% dividend yield, which is backed by an 85% payout ratio. Traditionally, metrics like these scream classic widows and orphans stock, right? You know, a defensive, highly stable income play that you buy and just forget about. But the plot twist here is that Sempra is layering an aggressive, high-growth narrative right on top of that ultra-stable foundation.
Moving on to Section 2, let's break down that $65 billion plan. Out of that roughly $65 billion capital plan for the next 5 years, a whopping $38.2 billion is earmarked purely for Texas utilities, specifically Oncor. Meanwhile, California gets $23.5 billion, and Sempra Infrastructure gets about $3.2 billion. So Sempra is betting heavily, and I mean heavily, on Texas. The state's massive economic expansion and surging power demands means Sempra needs to build out the grid aggressively. It makes Texas the absolute focal point of their future rate base.
But wait, there is actually more. On top of that fully funded $65 billion base plan, Sempra's management has a clear line of sight on an extra $9 billion in incremental capital opportunities. And guess what? Those are predominantly focused right back on Texas. In a recent earnings call, CEO Jeff Martin basically said that with these additions, they expect to pull the majority of their entire rate base from Texas by the end of the decade. They are essentially transforming themselves into a Texas-first utility.
Let's move to Section 3, winning the regulatory game.
As you probably know, a utility company can plan to spend $65 billion all day long, but if regulators don't allow them to earn a return on that spending, well, it's just dead money. Fortunately for Sempra, they've been securing some massive regulatory victories lately to de-risk all these investments. First up, the Texas Public Utility Commission approved Oncor's base rate review. They authorized a 43.5% equity layer and set their return on equity, or ROE, at 9.75%. In simple terms, regulators are legally allowing them to earn more profit on the infrastructure they build. Next, Oncor submitted a $4.4 billion UTM filing to recover capital spent since early 2025. And out in California, SDG&E filed an uncontested settlement with FERC that, if approved, bumps their authorized ROE to an impressive 10.28%. These aren't just boring administrative updates, guys. These directly and materially boost the bottom line. You might be wondering about that UTM filing. UTM stands for Universal Tariff Mechanism. Plainly speaking, it's a specific regulatory tool in Texas that lets utilities roll newly built transmission and distribution assets into their rates every single year. And why does this matter? Well, because it drastically reduces what's known as regulatory lag. Instead of waiting years for a massive rate case to get paid back for building a new power line, Sempra gets those assets earning returns much, much faster. Over in California, though, it's a much more delicate balancing act. Sempra has to deliver those investor returns without completely crushing the consumer. The recent SoCalGas rate request for 2028 through 2031 asks for the lowest percentage increase in over a decade. Actually, natural gas bills represent just 0.6% of the median household income for their customers, which is the best among peer utilities in America. So they're proving they can successfully fund essential safety and compliance work while keeping customer affordability a top priority.
Okay, Section 4. Energizing Sempra infrastructure. The ground-level execution here is super sharp. While regulated utilities are definitely the stable core of the business, Sempra also has a highly strategic portfolio of non-regulated infrastructure assets that are hitting some major milestones right now. Down in Mexico, ECA LNG expects to ship its very first cargo next month. The Cimarron Wind Project is now officially online and operating. Meanwhile, Port Arthur LNG Phases 1 and 2 are totally on time and on budget. Plus, Sempra is actively simplifying the whole business. They're targeting the sale of non-core assets like EcoGas later this year to recycle that capital right back into their lower-risk U.S. utility growth. It's a very smart capital loop.
Finally, Section 5, the shareholder outlook. Let's see what this all means for us.
We've talked a lot about billions in spending and dense regulatory mechanics. But let's synthesize what all of this actually means for the value of the company and potentially your portfolio. Consider their earnings per share trajectory. Management just affirmed their 2026 EPS guidance range of $4.87 to $5.37. But because of that $65 billion capital plan and the massive 11% compound annual growth rate in their rate base, they've put out a highly robust 2030 outlook of $6.70 to $7.50 per share. That essentially supports a projected long-term EPS growth rate of 7 to 9%. And frankly, that is one of the highest growth rates you will find anywhere in the regulated utility sector right now.
So the absolutely crucial point here is the number 16. That represents 16 consecutive years of dividend growth, and they definitely aren't stopping there. Alongside that impressive earnings growth we just discussed, Sempra's management is targeting 2 to 4% annual dividend increases across this entire 5-year plan period. And they plan to do this while completely eliminating the need to issue new common equity to fund their base capital plan. It is a perfectly balanced recipe of current yield and durable long-term growth. Which leaves us with one final, pretty provocative question. Can Sempra truly sustain its 7 to 9% growth all the way through 2030? Look, they have the regulatory wins, they have the fully funded capital plan, and they clearly have an undeniable demographic tailwind in Texas. But executing a $65 billion infrastructure build-out, that is a monumental task involving insanely complex supply chains and immense labor requirements. Can their ground-level execution actually match their boardroom ambition? That is literally the multi-billion-dollar question to watch over the next 5 years. Thanks for joining me on this explainer, and I'll catch you on the next one.